So first of all, you have to be accredited. There are some exceptions. Any one of these deals can have up to 35 unaccredited people. So if there's somebody that doesn't quite meet those qualifications, they're just going to be asked to tick a box, and a few people that aren't accredited can be let in. Then you have to be able to come up with a minimum. And if something is a 506C, the 506B, if it's a 506B, the general partners cannot market it broadly. They can only let investors in who know them. You have to have a relationship before a particular property is released to investors.
Yeah, we try not to do only market data, because I think that if they're in the mode to buy or sell, they care. But what about those 7 years in between? On average, people move. Well, I think it's even 5 years now, but still, how do I say relevant in their life for the next 5 years before they buy or sell, so that they reach out to me when it's time? And so for us, it's, on our consumer stuff, it's very localized. Here, yes, there maybe it's a little bit of real estate.
Okay. Hey, everyone. How's it going? My name is Nick Baldwin. I am co-founder of LabCoatAgents, and we have a special guest, Shannon Aronson. And Shannon is a Keller Williams brokerage owner. Her market centers have about 800 agents total out of 3 market centers. She's been in the business for 2 decades, give or take. Right? I don't know.
That's a long time. You're making me sound old.
Well, I've been in the business for 16 years. It's not like you've been in it much longer than me, but it does seem like it was yesterday. And today we're going to talk about something that Shannon is very passionate about. We're going to talk about creating massive wealth with multifamily syndications. I feel like, many times agents don't really invest in their own product. So let's talk a little bit about how they can do that. But thanks for being here, Shannon. Appreciate it.
Thank you for having me, Nick.
Tell me what. Oh, go ahead. Yeah.
Pull up, because I just want to talk about what you were just talking about. Pull up that second slide. Not your face and my face. Forget that.
The second slide. Okay, I'm gonna pull it up right now. Here we go. I'm very prepared, I promise. This one?
Yes.
By Andrew Carnegie?
Yeah, as you were just saying, we need to invest in our own products. 90% of all millionaires become through owning real estate. We know that. That's nothing to do with realtors, but as you and I both know, and I think more people are jumping on this bandwagon, shame on us if we don't find a way to get in the game, because we have the right to trade as insiders legally, and we're the first ones that hear about deals. So when you say I'm passionate about this, I really am. I got into real estate, like some people, I got into real estate the back door by starting flipping and holding, etc. Mm-hmm. So we all need to do this. And there's a lot of people that hear about these kind of investments and they say, well, wait a minute, I can't afford those yet. Well, okay, I couldn't either when I started, but let's create a vision of owning a lot of real estate and generating massive wealth in real estate, because we have a lot of access. So that's my preaching on that one.
Yeah, no, it's great. I think we need to tell everybody what multifamily syndication is. So do you want to explain what that is?
Yes, I do. Let's pull up that next slide.
Okay.
So there you go. The word syndication really just means partnership. You could syndicate anything, right? You could syndicate a manicure shop, whatever it is. But what we're going to talk about today, and there's a lot of people, especially in the realtor community, who are playing in the same sandbox of multifamily syndications. They're buying apartment complexes. Now, typically, there's all sorts of ways to do this, but typically a lot of the people that I know and like and respect in the space are all doing it in a very formulaic way. And I like that, because I like it when you have a model and you follow the model. I think there's a lot less room for error. So let me tell you a little bit about the model. The limited partners on the right are going to do all the things I'm going to tell you about. Excuse me, the general partners on the right, and the limited partners are really just going to invest money. Okay, so a general partner is going to go out and find, in this case, an apartment building, usually 70 units or more, because that's when it starts to make sense to have a full team of property managers, etc. They're going to negotiate and get the place under contract. They're going to risk upfront capital. These kinds of deals are a little different than most of us realtors know in our residential world. You put down a deposit often when things are under contract, and if the deal falls apart, that money is usually returned. With these deals, that money is typically at risk and it doesn't come back. Then the general partners do all the due diligence, run the inspections, check all the numbers, make sure everything is what was advertised. They hire and oversee property managers. They create a value add business plan. Most of the people doing these look for properties that are typically B and C class, where there's something they can do to add value so that they can bump the rents and then sell it typically 3 to 5 years at a higher value. They underwrite the deal, just a fancy way to say they run all the numbers so they know what the rents need to be to start making money, how occupied the place needs to be to start making money, how much raising rents should raise the value. They secure the bank financing, they conduct investor consultations, and we're going to talk a little bit about why that's really important. They raise capital with investors, i.e. the LPs or the limited partners. They conduct continual market analysis, and they determine the exit strategy so that the limited partners, which we're going to talk about now, are going to put money into these deals with certain assumptions. So it's the general partners deal to make sure all those assumptions happen. So limited partners, in which most people on this call might have an interest in being, if they aren't already, is literally just someone who invests. And we'll talk about what the typical returns are for these kind of things. But let me just start by saying, of course, everything I'm going to tell you should not be misconstrued as financial advice. I'm going to talk to you about tax benefits that realtors enjoy, but you should, of course, speak to your accountant. Everybody's situation is different. So take what I'm telling you as a general overview of how this works. But limited partners, or people that just invest in these, typically reap great tax advantages, collect distributions along the way, and when the property is sold, that's when they really typically get large returns. Let's kill the screen for a minute, and let's just talk a little bit more about what that means.
Yeah, so limited partners, that sounds interesting. So basically, like, if you know of someone who's looking for investment properties, like, you could essentially kind of put your money into the pile, or is that kind of
you're exactly right. So most realtors we know are so busy that it's great. A lot of them do own single properties here, 2 families there, but we know you got to be the landlord, you got to find the tenants, you got to call the plumber to fix the pipes, all the things that people don't necessarily like about being a landlord. All of that goes away when you simply put your money in the pile, as you said, and let the general partners take care of it.
That sounds like something I would just rather do.
Sounds, you know what? Me too. That's why I'm playing the game. I don't like the frozen pipes and the oil tanks and the asbestos.
No, here's like 10 grand. And I'm just throwing a number out. I have no idea.
Well, so let's talk about that.
Okay.
You can probably find them at all levels. Most of the ones that I'm hearing about these days from reputable people, such as myself, hope you put me in that category. Most of these are running with a
I do.
50,
don't worry.
You do. I know you do. I think I've earned it, hopefully. Most of them have a $75,000 minimum, some of them a little higher, some you can find a 50. So how do you get in? Let's talk about that, because it's not so easy. It's not for everybody. The SEC oversees these. They're called 506B or 506C syndications. The vast majority of people that we all know in our realtor world are running 506B. And what does that mean? It means almost everybody that puts their money in the pile has to be what is considered an accredited investor. And so that is, in the eyes of the IRS, somebody who has at least $1 million net worth, not including their primary residence, and earns at least $200,000 a year. and has a reasonable expectation of that continuing. If they're a married couple, it's $1.5 million and 300. So first of all, you have to be accredited. There are some exceptions. Any one of these deals can have up to 35 unaccredited people. So if there's somebody that doesn't quite meet those qualifications, they're just going to be asked to tick a box, and a few people that aren't accredited can be let in. Then you have to be able to come up with a minimum. And if something is a 506C, the 506B, if it's a 506B, the general partners cannot market it broadly. They can only let investors in who know them. You have to have a relationship before a particular property is released to investors. So, Nick, for example, when I do my next deal, if you wanted to participate, you and I have known each other a long time, you'd be able to. If somebody on this call likes what they hear and they say, well, wow, I'd like to start doing some of those, that's great. I'm going to give you guys a scan code at the end, and you can jump into my website where you can sign up to have a consultation with me. If I don't know you before now, you wouldn't be able to do the deal that I'm going to be offering next week, but we would establish a relationship and the next one. But that's what makes these, in a way, kind of sexy, because the SEC set this high bar to get in, and you have to know somebody. And that's why, as realtors, we all need to play, because we are the ones with the information for these very lucrative and, in my opinion, low risk deals.
So it is about who you know. It's
As I like to say, it's not about who you know, it's about who knows you.
Oh,
you.
There you go. There you go.
All
right. So then you were talking about tax benefits, right? So what are they that you can, what are the tax benefits that we can get?
Okay, so they're really, really cool. In 2017, the tax code was changed. And so, Nick, if you and I buy a house, we can usually depreciate it over 27.5 years, right? These kind of properties, these investments are, in a normal world, 37 or 37.5, I can't remember, years that you depreciate it. In 2016, the then president said, well, wait a minute, I have an idea to incentivize people to put more money into into housing, affordable housing for people. How about this? We let everybody depreciate 100% in the first year. Now, after this year, that's going to go down to 80%, and then 60% and 40 and 20 if the rules don't change. But so right now, if you invest in one of these, a cost segregation analysis will be done. So a team of engineers and appraisers come in and they separate out what's depreciable versus what isn't, right? The land's not depreciable, but the structure inside. So sometimes they'll say 60%, 70%, whatever it is. Let's use an even number. So if you invest $100,000 in one of these, you're going to get a K1 that's taking everything that's depreciable and your portion of that, and they're going to let you depreciate it all in year one. So I have a couple, if you go back to those slides, I have a couple of my own you get a K1 for these. I have a couple of my own K1s that I'll show you.
Is this it?
That's it. So this is a K1 I got for an investment that I did in 2020. And you'll see if you go down to section L, I invested $75,000 and I got a net loss of $57,000. So that meant I got to take $57,000 straight off my real estate income, saving, whatever it is that I would pay on 57. Everyone's tax rate is a little bit different. So that's a reasonable amount of money. If you calculate that somebody's at a 30% tax, so 30% of whatever I would have paid on 57, it's not chump change. So that automatically really lowers the investment that you put in. It's a lot more complicated than that. But I think scroll down. There's another one. There's a different property that I threw a K1 in for. Is that the next one? They look the same. Okay.
Yeah, I just want it's changed.
Okay, one is 75, I got 57. The next one is 75, I got 52. Because the cost segregation analysis dictated on that one that a little bit less was depreciable versus land. And so that's a sizable tax advantage. You know, what a lot of people say is it becomes addictive because if you do one this year and one next year and one the following year, you're really getting to take a nice, reasonable chunk of change off of the money that you pay for. Now, the reason this is more appealing, these are great deals for everybody. The reason they're more appealing for realtors than other people is these deductions only apply off of certain kinds of passive income. So there are things other than real estate where you could take those losses. And even if you're not a real estate professional, you can carry it forward. But for realtors, there's a really wide range of things that we could take it off of. So let's say you own a couple of investment properties, you own an Airbnb, you have your real estate income, etc. You can take that off any income, not just passive real estate income. For other people, if you're a doctor and you have mostly W-2 plus a stock portfolio, you can't deduct it off of anything other than income that came from that property. Does that make sense?
Yeah.
So take me down to the next slide. So, all right, we skipped it. Let's skip
Oh, we
over
did
that
this
one.
already.
Yep. Okay.
This one?
So this one's important. So here's how it works. You put in your money, and then here's my favorite part. This preferred return, the second from the right. What that means is that the general partners aren't going to take any profit until the limited partners have made at least what is promised in that preferred return.
Oh, so the limited partners get a return first.
The limited partners get a return first. And until they get an average of 7% a year, the general partners don't take any profit.
Oh.
So you're going to get paid some distributions along the way. Sometimes they're quarterly, monthly, biannual, annually. It doesn't matter. Each deal is a little different. You're going to get money. Now, let's say in the first year, they haven't been able to bump the rents enough to get 7 and you only get 4%. It's fine. The next year, maybe you do get 7%. The next year, maybe it's 8%. You're still a couple of percent behind. So let's say in the third year, they go to sell this thing. First, the bank, of course, gets paid. Then everybody gets their 75 or 100 or whatever they put in. That's next. Then the next thing that has to happen before anybody else gets any money is everybody has to at least get 7% a year. Then after that, they take the rest of the pile of money that's there, and the general partners get 30% of that, and the limited partners get 70%. Now, these are typical projected returns. You can look at a lot of these deals. Most of them are very similar. By the time it's sold, you should have gotten 16 to 18% a year, plus the preferred return. That's just from profit. Cash on cash, that's what people expect they're going to pay out along the way. And then in this one, if they held it for 5 years and then sold, the equity multiple would have been 1.89%. So you're almost doubling your return, plus getting that nice tax advantage. What do you think?
I think it's awesome. Like, I think that, listen, at the end of the day, like, it's all about the passive income. I mean, it's just putting your money to work. How do you find people who are doing this?
That's the hard part. It's like anything in our world, you got to network. And that's why I was happy that you asked me to do this, because these deals are very hard to find. And so when you know someone like myself who does them, even if you're not sure you're ever going to do them, reach out, have a conversation with me, because then I'll put you on my list when they're available. And you can always jump on. Here's what happens when we have one. And I was actually just traveling yesterday, as you know, Nick. We just did some due diligence on one that I'm really excited about. When the general partners find one, they then will advertise a webinar. And you watch the webinar. What I'm talking to you about right now, of course, is generalized multifamily information. When you jump on one of these webinars about an actual property, that's when you're going to look at all their underwriting. You're going to look at why they like a particular area and a particular unit. And then if you like to do it, then there's an investor portal and you invest your money right there. Reminds me, though, that I forgot to tell you a couple of things. For the most part, at least the kind that I do, we really are looking in states that have high population growth, diversity of employers. We don't want to buy somewhere where they're completely dependent on a military base or completely dependent on oil or completely dependent on auto. We look for diverse employers. We look for places where they're really not building a lot because they're not able to land-wise, and in states that are landlord friendly. So Nick, you've lived in New Jersey. That's typically a state that ranks as incredibly landlord unfriendly. So we're not doing
tenants. Yeah. Not very friendly to landlords.
No.
So that's why you go out of the state a lot to find these. I have a
Yes,
question about how much money is expected of someone. You know, I mean, I'm sure that it's has to do with like the cost of the deal, but is there like a certain percentage that, or is everybody different with how much they expect?
Well, it really has to do with financing. And as you know, right now, it's getting harder. And so in order to get attractive loans, right now, most of the people doing these deals are having to have more money, put more money down than they did, you know, a couple of years ago. So for instance, the one that I'm going to be talking about next week is right about at $20 million, the property, and we're borrowing 12.
Oh, so it's like an apartment complex probably, right?
They're always 70 units or plus. This one happens to be 79,
wow, big
yeah, like grown-up apartments. Yeah.
Like a lot of times when you like, I mean, I knew that, but a lot of times when people say multifamily, they're like, what, a 2-family house? What?
I know. I don't know why they're called that, because it's totally not what most of us think.
It's an apartment building.
It's an apartment building. So they're big cash raises, and that's, you know, partly why the minimum is 75, but also, you know, because of that, the SEC thing about being accredited, it's the general partner's responsibility. And that's why they need you to have, you know, somewhat of a relationship with someone so that you can be sure that it's financially feasible for them. You know, the downsides of these, and I just love them, so I hate even talking about them. When you're a limited partner in these, it's not up to you when you get out. Most of the time, they're a 3 to 5 year turn. And so if at 3 years, the market's great and the general partners think, whoo, let's sell, now's the time to take our cash out, then it's going to sell. But, you know, this is what you and I love about real estate. If the market stinks and it's not a good time to sell, they're going to hold it longer. As a limited partner, you have to be in a position where you can let that money stay at work for you, because you can't dictate when you get it back.
And the market always comes back around.
It does.
You know, that's the thing about real estate. What
and the rental market is strong and predicted to be even stronger, sadly, because I'd rather everybody be in a home, but that's not the reality right now.
You mentioned a couple things that you look for, and like, you know, landlord friendly states or cities or whatever. But what else are you looking for when you're looking for these types of properties?
So typically they're what we call B or C class properties, but if possible in an A class area. So, you know, you think about everybody that we know that's developing, Nick, they're, for the most part, they're building luxury things, right? But all those sort of working class people, you know, depending on what state, they might be earning $40,000, $50,000, $60,000 a year. They're not necessarily looking to get into a luxury place because that's not what their budget is. And that's another part of this formula that I really like. No one's building B class. So there's a limited supply. So for all the people whose income dictates that they're in a B class, or, you know, just a step down from luxury, there's no inventory coming from anywhere. And that's what I really like about these. So you want somewhere where there's diversity of employment. You want somewhere where the population is growing. For instance, very interested in South Carolina right now. It comes up on all sorts of different graphs and charts as being the third fastest growing state. So you've got a lot of people moving in, nobody buying that kind of real estate, nobody building that kind of real estate. It creates really strong demand. And then we like a place where we know we can, part of the money we raise is CapEx or capital expenditure, so that we know we can go in and do whatever it is we dictate. Always like to try to add value to the people that live there so they stay. So maybe it's a dog park, maybe it's picnic benches and a fire pit area, maybe it's upgrading the playground area, redoing kitchens. And, you know, in this industry, we all know you can do things like kitchens and bathrooms, especially for investment properties, cheaper than if we're doing it for
Yeah.
ourselves. So we want to look for properties where we can do a value add.
Yeah, because amenities are definitely something that people look for. So like I guess you hire staff, or you keep the staff that's there, or you hire a property management company, or how does that work?
For sure. And that's what most of the time these general partner groups are teams of people. And there's usually at least one or two people that are local, other people from all over the country that have, you know, relationships with nice people like yourself that we can help provide the opportunity to people. And then we make an assessment. Maybe the reason that you buy a place that's not doing very well now is because the property management team that's there stinks. And
Yeah.
we find a better one, we bring in a better one, or maybe the property management that's there is fine and somebody's selling for some other reason. Maybe they didn't have the money to do the capital expenditures that they needed. So every case is different. And then the general partner team works with the property manager to determine the business plan, what things we think are going to add the most value to the property, get quotes to do them, oversee it getting done, and then making sure that we're bumping rents as aggressively as possible without creating too much vacancy. Who better to do that than a bunch of smart realtors, Nick?
Yeah. No, I mean, seriously, guys, come on, let's get it together. Anything else we should touch upon? Let me take a look at your.
You know what? Pull up that last slide. I want to give everybody the scan code.
Oh, yeah.
Wait,
let's go over some of these.
Oh, yeah.
These are good.
Yeah. Look at that. We've seen those 100 times in 100 places. Same thing. Paint the cabinets, put on some
This is
countertops.
cool.
Yeah.
I love that. That looks good. I mean, obviously you have to wait till someone moves out to do this.
Yes, but as an example, in the case of the one that I'm going to be unleashing next week, as soon as somebody's lease turns over, we are going to push rents up towards market value. And so some of them I want to stay. I mean, you know, that feels yucky, but it's a business and you got to protect your investors.
This is cool.
Isn't that nice?
Look at that new state-of-the-art playground.
Exactly. You know, Nick, I have an LLC that is what I do my investing out of, and it's called WAVE, WAAV, real estate, and it stands for We Always Add Value. And my philosophy is that if you add value to the tenants, you're going to be adding value to the investors, you're going to be adding value to the team. And, you know, I know you and I both share that philosophy that it's kind of win-win or no deal. So you do this, your tenants want to pay more, they want to stay, they want their friends to live there, you have lower vacancy rates. You got to take care of everybody.
So if you guys want to like talk to Shannon about this, the opportunities like this, get to know her, because it is about who you know and who knows you. Scan this code and drop her a line, because
if you scan that code, it'll take you to a page and we can just schedule a 15-minute call, and there's zero pressure. Even if you just want to know more and you want to start getting in my flow of these deals, just to even watch them and see how they go. Absolutely. I don't mind if you do a deal or you don't do a deal. I just want everybody to learn about these. They're just fabulous opportunities.
Yeah, just scan it. You just enter your name, email, phone, and just type a little message and say,
say, I'd love to have an investor intake call or I'd love to talk to you. Whatever you write, I'll call you.
And think about it. Like, if you're a limited investor, you're just letting your money work for you.
I like to say that you need to get, hopefully I'm allowed to do a little swear word, Nick, but you need to get your money up off its ass and out going to work for you.
How dare you?
No,
just kidding.
I'm sorry.
We're growing up.
But it's true. Your money can't just sit there. And you know what? I've actually gotten a little bit of criticism recently, Nick, from people who said, Shannon, you're talking about these investments, but they're out of reach for a lot of us. Okay, so there's a couple of things you can do. Number one, if you build it, they will come. So if you're not ready to do it, it's fine. Start thinking about it and the world will collude to help you. That's number one. Number two, my son, for instance, I have a son, he's now 25. He's been doing this with me for years. I did them and he contributed 10%. You can, set up an LLC with somebody as a side deal, and that LLC can buy it. So you could put in, 20 and somebody else 55 or whatever it is. So there are other ways to get in it.
Also, I mean, listen, also, if maybe you have a friend or family member who, had a couple good years and they have a few bucks laying around, and you're like, hey, listen, there's these deals that I know about, and how about, if I find a deal, would you be willing to put some money in? And then we kind of like, I find it, you put your money in, we split the what's the word I'm looking for?
The depreciable assets.
Yeah.
Profits. But here's where it gets really cool, Nick. I had this conversation with a friend of mine yesterday. She's a little cash poor right now because she had just bought another investment property. She has a brother who's not in real estate and isn't really going to be able to take advantage of the tax deduction. So she said, how about we split it? And just so you know, you're doing me a favor because I'm going to take the whole tax deduction.
Oh, yeah. There you go. That's a plus.
How about in exchange for me building a relationship with Shannon or whoever else you're going to do one with, that you take the deduction and let the other person just get the distributions and the preferred returns and the overall returns at the end when you sell.
Yeah. It reminds me of what Gary Keller said when we were at that wealth seminar. He said, for most people, it's not about not having the money. It's about not knowing what to do with it when you have it, because there's money in front of you all the time. You just have to go to somebody and say, hey, I know this great opportunity. If I find more opportunities like this, you put your money in and we split the returns.
Yeah, set up a little LLC with your wealthy uncle or fill in the blank, whoever, and go out and find them deals with people like me and many others who are doing this.
Yep. Sweet. Well, listen, scan the code, have a conversation with Shannon. You can find her. Where can they find you otherwise?
They can find, I'm going to put, there's not a chat.
There is a chat, but just say it out loud for people watching on Facebook or YouTube.
You can reach me at Shannon Aronson at kw.com. Or I think my multifamily syndication website email is also in there, which is Shannon at WAVRE. That's WAAVRE.com. Or find me at that scan code, and we can talk.
Awesome. I learned a lot.
Did you?
Yeah.
That's awesome. It's always nice to see you, Nick.
Nice to see you too. I was paying attention. Don't worry. Thanks guys for being here. If you liked what you watched and you're watching this on YouTube, don't forget to hit the subscribe button and click the notification bell so you get notified when LabCoatAgents uploads new videos. And we will see you next time.